The topic for today's presentation is about active management of funds. All of you must be aware, since you are investors in mutual funds, that active managers invest in portfolio of stocks and try to outperform the market. And that outperformance is called alpha. And over a period of time, there has been a downward trend in alpha because market is becoming more institutionalized. If market is not institutionalized, there will be large opportunities for investments where informed decisions can be made, and hence that ability for active managers to outperform is large. So in the last year and a half, there have been questions about whether the alpha generation is dead in the industry, because while the market, which is your Nifty and Sensex, are doing well, many funds have not been able to generate that kind of returns or returns over that. So my topic today is to talk about whether the alpha generation is dead or not. Before we talk about whether it is dead or alive, we need to see it, what is the trend in the industry, what has happened in the past. If you look at 1 year, obviously you will see that most funds have not generated alpha. But you need to look at 20, 30, 40 years. That is when the businesses will keep evolving. That is when the investments will start showing a particular trend in terms of whether that has been achieved or not. What we did for that was to take the large cap category and see how large cap category has done vis-a-vis the benchmark. It's not about one single fund. It's not about a best performing fund. It's not about a worst performing fund, but the category average of large cap funds. And you will see that the red that you will see, those are the periods when there has been a negative alpha, which is, for example, if it is compared against Nifty, Nifty may have given 15%, the funds would have given slightly lower than 15%. So those are the point of times where there is a red line. And there are also lines on the other side of the axis, which is green, where suppose Nifty has given 15%, the funds would have given higher than 15%. What you will see clearly, there have been a lot of positives and negatives on a 1 year time period. But when you look at 3 years, you will see that, this is 5 years, you will see that for most periods of time, the funds have generated alpha. Or to simply say that if you are investing for long term, the active fund managers can create that additional bit of returns for you. But in a time frame which is short, whether it is 3 months, 6 months or 1 year, there could be volatility in terms of alpha. Same is the case with mid caps. When you look at 1 year returns over the mid cap benchmark, you will see periods of underperformance. It's a cycle. Every 3-4 years you will see cycles happening. But when you look at 5 years, those cycles are longer. So there are periods of outperformance which can last for longer periods. There have been years of underperformance for mid caps. For example, in 2001, in the calendar year, it fell 30%. What happened next year? 24% positive returns. If you invested in 2001, in the next 3 years, a CAGR return of 55%. Similar have been the cases in 2008 and 11 as well. After a strong fall, you will always see markets coming back. It's like a pendulum. It won't stay there. It will come back. But at what point you invest and what point you exit would be critical for your wealth. Now again, 2018 we have seen almost 18% drag in mid caps. What could happen in 2019 and 2019 to 21 is somebody's guess. But definitely if you go by history, you will not be wrong if you take a slightly higher allocation to mid caps. Small cap, same example, you will see the difference. In a year where it has fallen 71%, the next year it has given 100% returns. CAGR return for 3 years is 17%. Same example in 11. 18 was a year where it fell very, very sharply. So what happens in 1921, we don't know. But there is some history that can be bet for or against. So in terms of the process, I think these are the processes, 4C. So you have covered 4 C's for the process. What else needs to be done? Say only process is not sufficient. You need to have patience, because you may be doing right things, but markets are markets. They may behave in a different way. Process plus patience is what is required for sustained performance. And believe me, investing is not a sport. Unlike in gymnastics where you get a perfect 10, or in archery or shooting where you can hit a bullseye, You will never be able to do that in investing. So don't try for a perfect 10 or 100% accuracy. You will go wrong, be ready to go wrong, but keep reviewing your investment decisions. This is what Peter Lynch, one of the famous investors, said. In this business, if you are right 6 out of 10 times, you are good enough. You don't have to be right 9 out of 10 times, right? So if you are right more often than wrong, that itself should give you outperformance or a sustained performance. So finally, let me end with a little bit of cricket. We are in the World Cup time. So in terms of patience, what you need to do, or in terms of preparation, what you need to do. This is net practice, right? You keep practicing, you keep seeing every annual report, you keep analyzing each company, but you are still practicing, you are not investing. You will go and assess the pitch, which is, you will go and see whether there is a political stability, whether there is a positive policy push, whether the valuations are fine. You will see all that. You will see the competition. That's inspecting pitch, inspecting the weather as well. So that's another thing. When you do that, you can actually hit a 6 and win a World Cup. So thank you so much.